in real world terms, not just theory, but on the ground. Let's talk through what people should be looking to influence in their markets.
In the realtor world, you ask a realtor, what are the three most important things in real estate?
Location, location, location.
I've come up with what are the three most important things in housing affordability. We're only going to change one variable. We're not going to change building costs. We're not going to change permitting times. We're not going to change construction costs. We're not going to change labor costs. We're going to change one thing and one thing only. Small lot, small lot, small lot.
Welcome back to Keys to Real Estate. I'm Mary Schuster. Well, in our last episode with Ed Pinto, we examined why housing affordability has become so stubborn and why so many well-intentioned policies end up just making the problem worse. Now today, we're going to turn to the harder question. What would actually work? Ed Pinto of AEI walks through a set of ideas that focus on outcomes instead of optics, freeing up existing housing stock, incentivizing states rather than micromanaging them, and fostering local success. If you're looking for practical solutions, especially when talking with your state and local officials, Ed has a ton of great ideas regardless of the unique needs of your market. So let's get right back to the very knowledgeable Ed Pinto. The presenting sponsor for this season of Keys to Real Estate is First American Trust. First American Trust redefines banking for title and escrow companies. They offer innovative solutions that integrate banking functions directly into title and escrow software systems, enhancing operational efficiency and safeguarding financial transactions. At First American Trust, you have direct access to a personal relationship manager who delivers answers in real time. First American Trust is also recognized as an elite provider for the American Land Title Association. As a wholly owned subsidiary of First American Financial Corporation, they have roots in real estate tracing back over 135 years and is the only bank owned by a title company. With deep roots, advanced solutions, and a commitment to real relationships, they are setting a new standard for the industry. The future of banking for title and escrow starts with First American Trust. Visit firstamtrust.com to learn more. Welcome back, everyone, and welcome back, Ed. I'm so excited to get to even more solutions, mostly supply-based, because we know that's what makes the most difference. I know you have some more prescriptions, especially at state and local, which I definitely want to get to. I like the prescriptions you've had at the federal level. Our title and settlement agents are getting ready to do their fly-in week into D.C. soon with advocacy, and I think you've given them some really good tools to take with them or keep in mind. One other thing that I wanted to check with you on in that larger picture before we get to more granular solutions locally. You spent a lot of time doing credit risk analysis in the years leading up to the 2008 situation that we all endured. And it's led me to wonder, when you look at today's mortgage market, what, if anything, concerns you about current risk levels or underwriting trends? And if you do have concerns, are they similar to the run-up that happened to 2008, or are they entirely different this time, if there are any?
So let's unpack that a little bit.
Okay.
First of all, and this goes back to some of the things the president has said, I don't want to make this sound too nonchalant, but it's very hard to tank home prices. It's only happened in big numbers twice in our last roughly 100 years. It happened in the 1920s, exactly 100 years. 1927 was the beginning of the single-family property crash and predates the Depression. Property values nationally dropped. The data weren't as good back then, but best as you can tell, a little under 25% nationwide, which was huge. We've only had one similar event, and that was, you alluded to, the 2008 Great Financial Crisis, which in both cases, they were predated by a home ownership craze. Back in the early 90s, it was called the Better Homes Movement. When that was released in 1922, the forward was given by, I think it was President Warren G. Harding. A number of government departments were involved in it. They didn't provide financing and things like that. That hadn't come about yet. That was saved for the Great Depression. But they were really promoting home ownership, and they were really cheerleading that. And what really happened was new construction lots. They were doing a lot of subdividing lots, and they really got over their skis in all of this. There were lots of bad underwriting that was going on, and That all collapsed in 1927-28, with the epicenter being Florida. The same thing basically happened in the run-up to 2008. The federal government, starting in 1992, with the so-called Government Agency Housing Safety and Soundness Act. My advice to anybody is when Congress says anything like safety and soundness or affordability, hold on to your wallet. Safety and Soundness Act was going to make it so Fannie and Freddie were impervious to any collapse, and of course in 2008 they collapsed. The Flood Insurance Act, which was going to make disasters less frequent and get people not to build in flood zones, of course the unintended consequences are disasters have gotten more because it actually became a way to get people with flood insurance to build in flood zones. The unintended consequences that flow from what the federal government, you can write a whole encyclopedia of 50 volumes on. So that's one issue. Again, it's very hard to tank house prices relative to what's going on today. House underwriting tightened up, and it needed to, after the great financial crisis. We measure that year by year by year through what we call the stressed mortgage default rate, which says, okay, in 2006 and 2007, when credit was its loosest, before the collapse. The collapse starts in late 2007. So that was when credit was loosest. We defined that as the equivalent of the 150-mile-an-hour hurricane. If you want to know how loans perform, look at how they performed when credit was the loosest, which was that time period. And then we measure all of the metrics at the point of origination for those loans of credit score and combined loan to value and debt to income ratio and property type and tenure. Is it rental? Is it investor or owner occupied? Is it a secondary home, a vacation home? Is it an ARM? Is it a fixed rate? Is it a 30 years? Is it a 20 year? We've looked at all those things. What was the liar loans? Did it have interest only? Whatever. We have all of those variables. And we've looked at all those variables, and today's loans eliminate most of the more egregious parts of that. So we basically say, well, how are we doing today compared to 2006, 2007? And the bottom line is we're at about half, a little over half the stress mortgage default rate, which says if we had another event like the event we had back then, which I'm not saying we're anywhere near that, but if we were to, this is the level. And that level is roughly half. So that leads us to be not sanguine, but at least comfortable that we're not over our skis in credit risk. There is one exception, and that is debt to income ratios. In the run-up to anything, when we look at credit risk, the two biggest factors are credit score and down payment, or the converse, which is combined loan to value. Two most important. But under stress, the debt to income ratio, which we have front end ratio, which is the housing debt ratio, but we've only recently got that from a different data supplier. But the GSEs and then Ginnie Mae don't publish the front end ratio. They only publish the back end ratio, which is the total ratio. And the trends on that have not been good. Those debt ratios keep going up and up. And they keep going up whether rates are going up, rates are going down, et cetera. They just keep going up because the federal government, no surprise, any government can rack up $38 trillion of debt, loves debt. So they love student debt, which helps explain why the student debt program imploded. They love debt, and they loved housing debt, which is one of the reasons that things imploded back in 2007, 2008. Now, we've kept the credit scores and the LTVs relatively under control. We don't have any of the funky stuff, liar loans and all of that, and one-year ARMs and things like that. But we do have very high debt ratios. Now, at least they're based on validated incomes, which is progress, but they are high and they tend to go higher. And the particular one that I get concerned about is FHA. And to the extent that FHA's share increases, which it has been, people do get over their skis, particularly if homeowners insurance and other things, taxes, property taxes are going up at the same time. Because while their monthly payment is fixed in terms of principal and interest with the mortgage, if it's a fixed rate mortgage, they have these other things that go up, and they also have other costs of living that go up. And if they already have a high debt ratio, Martin Luther King, in one of his last sermons, talked about this. He called it the drum major syndrome. And he said, look, we have too many people that are listening to and following the drum major, which is basically more debt. And he's talking about this in 1968. So this has been a problem for a very long time. It says economists say you should buy a house at no more than 2 times your income. Well, again, like Houston having a quaint homeless rate, we would give our eye teeth for that today. But back in the 60s, that was not unusual. The average might have been 2.8. And for lower incomes, it might have been closer to 2. He said, so you should try to be at 2, but we have people that are going to 3 and 4. And what they find is at the end of each month, they don't have any money left over. And that's a problem. You need to right size what you're doing. Don't get the most expensive car. Don't get the more expensive house. Go for the lower priced home that fits within your pocketbook. That's a term that doesn't get used very much anymore, but that was the expression, fit your pocketbook. And I learned, actually, Warren Buffett had some advice, which was pay yourself first. At the end of as you get your paycheck, whatever it is, weekly, monthly, bi-weekly, whatever it is, you save first and then you spend. What 90% of the people do today is they spend and say, oh, I don't have anything left over. So they buy all those lattes and they buy all of this and they do all this discretionary spending. And then they say, I don't have any money to save. Well, my mother she had a vacation club and she had a Christmas club and she had a Christmas club for each of the children. And she had a vacation club and she had all these things and she'd put away the money each week for that. And she had I think they had a 15-year term mortgage and they paid down the mortgage. And so they paid themselves first. And Warren Buffett said the same thing. Just, you have to pay yourself, you have to invest, have some money for investing, you have to do some savings first. And then that is what grows, with compound interest. I think Albert Einstein observed that the most powerful force in the universe was compound interest. So that's again, we've gotten away from that. And the federal government has led the charge there because there's no greater debtor culture than the federal government's debt culture, which is the only way you get to $38 trillion.
Yeah, exactly. Let's talk through what people should be looking to influence in their markets.
So I've come up with a very short explanation of that. In the realtor world, you ask a realtor, what are the 3 most important things in real estate? Location. So I've come up with what are the 3 most important things in housing affordability. Small lot, small lot, small lot. Small lots cost less land. You build smaller houses, they're still family sized, as I'll demonstrate, but the smaller houses cost less to build. And if you build a townhome, they take even less land, and townhomes are simpler and easier to build than a single family detached of the same size because you don't have as many exterior walls, you don't have as many windows, they're a simpler footprint, et cetera, et cetera. And so that's the solution. We actually did a thought experiment, but we did it on a massive scale. We went back and looked at all of the single family attached and detached homes that got built in the United States in new residential subdivisions. So we're not talking about building on an odd lot, vacant lot here or there. We're not talking about a tear down and building something. We're talking about you did a new subdivision and you built some homes on that new subdivision. Did this for the period 2000 to 2024. We found that in the United States, there were about 13 million homes built over that time period. We found that about 90% of them were single-family detached and 10% of them were single-family attached. We found that of the nearly 12 million that were single-family detached, they were built 5.4 per acre based on lot size. So that's about 8,000 square foot lot. We found that the 1.2 million townhomes were built at about 22.6 homes per acre, which is just around 2,000 square feet, which goes back to why I said 2,000 square feet in last week's session for the bounty. We then said, let's have a very simple thought experiment. We're only going to change one variable. We're not going to change building costs. We're not going to change permitting times. We're not going to change impact fees. We're not going to change construction costs. We're not going to change labor costs. All these things that people say, wait a minute, that's what's really driving the bus. We're going to change one thing and one thing only. Small lot, small lot, small lot. So we're going to say, what would happen if you were to take the single family detached that had 5.4 per acre at the median and you went to 8 per acre, which is the 90th percentile? Well, instead of getting 11.9 million homes on that amount of land, we're talking the exact same amount of land, you would have 17.6 million homes, or nearly 6 million more homes on the exact same amount of land. And those homes, and we brought them forward to today or 2024 as to what they'd be valued at. They'd be valued, the 11.9 million would be valued at 517,000, but the 17.6 million homes be valued at 463,000, which is about 50 something thousand dollars less, which is about 10% less. So you get a lot more homes at a lower cost. Back to the point about family size, you'd be going from about 2,300 square feet to about 1,900 square feet. 1,900 square feet is still a pretty decent sized house. It's certainly a 4-bedroom house. And so it's family sized. We also said, well, let's make one more assumption. Let's assume it were easier to build townhomes. There were, again, the legal constraints were removed. Builders would build them all day long if they got out of the way. And so let's assume that 20% of that land that was used for those 12 million homes that were single family detached at 5.4 per acre, let's assume 20% of that land instead got used for townhomes. Well, now, instead of 13 million homes, we're looking at 26 million homes get built on the exact same amount of land.
Now we're starting to get somewhere.
And right now we're starting to get somewhere. If that had happened in 2000, all of a sudden we wouldn't be talking about this. Just like in the free market, we don't talk about things more or less like clothing cost and computer cost and cell phone cost and you name it. And even up until recently with the pandemic, car costs. Cars were pretty reasonable relative to incomes. And it's only when the government sort of gets in the way, and the three I always come back to, what are the three least affordable parts of our economy? Healthcare, housing, and higher education. What are the three areas that have the most federal intrusion, where they say, trust us, we're going to make it more affordable? Not. As Ronald Reagan said, the 9 most dangerous words in the English language: I'm from the government, I'm here to help.
I'm here to help.
And so, that's the thought experiment that says, if you can get this Gordian knot that exists between the 33,000 localities, the 50 states, and the federal government, and harness that together to move this towards smaller lot, smaller lot, smaller lot, you will solve this problem over time.
All right, I'm going to put together a couple of concepts, one you shared last week and one we're kind of drilling down on this week. So one of the things that you have mentioned that the federal government could help with supply is opening up or making available some government-owned property. And some people hear that and get heart palpitations. So I'd like for you to tell people specifically what you mean by that, and then also just sort of check in on that, because, last spring, I remember Secretary Turner and Secretary Burgum came together, did a video that said, we're gonna release some of this land, which would not have all the local and state incentive problems and strictures, I'm guessing. I think they would probably...
Yeah, they never really clarified how they were going to do that.
But I'm just wondering how that's going and how that's another piece of the puzzle of impacting supply.
So last week I mentioned the bounty idea, and I included the Bureau of Land Management land as a piece for that I said that was used for residential development and sold to the private sector. So let's start talking about what we're talking about. Bureau of Land Management. The Bureau of Land Management manages the land owned by the federal government that is not national park, national forests, national monuments, military bases, you name it. It's the leftover undesignated land, and they had to put it somewhere, and they put it in the Bureau of Land Management. Up until somewhere in the mid-20th century, it was called the Bureau of Land Sales, because that's what they did. They sold that land because it was not needed for anything specific. It was undesignated land. That got changed to the Bureau of Land Management. The problem, as I see it, is once you change the name of the Bureau of Land Management, bureaucrats say, what's my job? It's not to sell. They took away that term. It's to manage, and you manage by not selling. It's notwithstanding the fact that the Act itself in Section 203 from 1976 says one of the purposes of the Bureau of Land Management is to sell land for economic development. What does economic development mean? Well, there's an expression I use, which is economic development needs homes. Why? Because that's where jobs sleep at night. And nobody tends to think about where jobs go to sleep at night. They like jobs, but they don't like the places where those jobs sleep, namely homes. So that's number one. We're talking about Yosemite.
Yeah,
We're
it
not
won't be
talking.
single family in Yellowstone.
Yeah, it's not Yellowstone, and that's the first thing people
Right. It's a
dissemble
misnomer.
about.
Right.
They just do this. I see it all the time, when they talk about this. The second thing is, how much land does the federal government manage, and where is it? Well, excluding Alaska, it's 277,000 square miles. That's the size of Texas, number one. So it's a lot of land, but number two, it's only in about 10 states, and most of it's in a handful: Utah, Nevada, New Mexico, and a few other states. For example, there's none of it in Texas. Texas ended up developing, doesn't have any federal land that's in the Bureau of Land Management. New Mexico, which is on the border of Texas, so El Paso is on the border of New Mexico, has a fair amount, but it's in New Mexico, not in Texas. So that's the second thing. It's 277,000 square miles, and it's concentrated in these 10 states in the lower 48. We've talked about, what if you took, horror of horrors, 270 square miles, or 1 out of every 1,000 acres, and you identified where it would be most suitable to sell that land off for residential development. In fact, Secretary Burgum, a little less than a year ago, was talked about this in an interview, and said, yeah, we want to focus on land that its natural use would be as residential property. Why? Because it's near other residential properties, near cities, et cetera, et cetera. So we've looked at, and we have all these maps and things, and I know you're going to provide the audience with how to get to this, but we've looked at all this land. We've identified the cities, how big they are, the areas, how much growth they're having, and we've right-sized where it's suitable, given their growth path, to sell land, these 270 square miles in these various areas. And so we're talking about a minuscule amount, and it's the land that's most suitable for this use. Las Vegas ends up being the poster child for this in two ways. A, it's a very rapidly growing area, but it's completely, like 97% constrained, like a growth boundary, by federal land. Not only Bureau of Land Management land, but National Forest, some that and the other, but a lot of it is Bureau of Land Management land, and therefore it can't grow outward because the federal government owns all that land. But Las Vegas also is unique because back in 1998, Senator Harry Reid, I don't know if he was a majority leader, but he eventually became majority leader, but he was a senator from Nevada, very powerful. He got a law passed, which is the Southern Nevada Land something or other, SNPFLA, I can never remember what it stands for, that said, there is a crisis in Las Vegas. It's one of the fastest growing markets in the country, and we need to do something about it. The federal government needs to sell land for residential construction, and Congress orders that this take place. Well, that was nearly 30 years ago. Well, they've sold some land. They got going relatively quickly initially, but then it slowed down and got mired into a lot of bureaucracy, and it's pretty much, petered out. And they still have a lot of the land that Congress said was an emergency to sell 30 years ago hasn't been sold yet. And they unfortunately put together a very bureaucratic process that, in effect, made it very difficult to actually do this, which, again, back to Congress, make sausage, that's what they do, is sausage making. And this is an example of sausage making. So the challenge here is, A, how do you do this in a way, we know where to target, we know how much to do, all of that, but you have to do it in a simple way. And the simple way, in my mind, is just follow what the 1976 statute provided, which is you auction the land off to the private sector, to the highest bidder. That's all laid out in Section 203 of the 1976 Act that set up the current structure of the Bureau of Land Management. So that already is there. And you can identify, as we've done, land that's suitable for this, and you just start putting it on the market. And so that's what we've suggested, whether the bureaucracy, at the secretary level, at the bureaucracy at the political leadership level, and the bureaucracy, most importantly, of the bureaucratic level, because, again, the Bureau of Land Management is a huge organization. It's these offices are not in Texas or Florida or whatever because they don't have any land there. They're out in these 10 or so states and they have offices out there managing. And think about it. What are they doing? They are managing the 99.9% that really isn't suitable for residential land development. That's what they spend probably 99.99% of their time on.
Leasing for
Leasing, grazing, this,
all those
that,
things. So they're
trading
creating
land,
some
doing
revenue
this.
there, but there's
Yeah,
this segment that doesn't that does not pertain to.
it's part of their jurisdiction, but they don't focus probably more than 10 minutes on that.
Well, I like the way you've helped me frame the thought differently because it sounds like you're thinking of it more like a next phase of Western
Of
residential
homesteading. It's the
expansion.
next phase of the
Yeah.
homesteading.
And so on my wall upstairs is, my great grandfather's homestead grant out in Western Kansas. And so it sounds like you're just saying, okay, let's do the next phase because we have this idle
We
land.
actually called it homesteading 2.0.
There you go.
And we tried to frame it. We thought maybe the president would get enamored with this. Maybe we should have called it Trump homesteading. I don't know.
That might
But
have helped. I don't know.
we said, look, you could actually do this and you could actually have a lottery. And you could say, okay, homesteaders 2.0. First of all, put your name in the lottery as having interest and identify 5 markets you're interested in, or up to 5 markets you're interested in, just to gauge interest, which would then tell Congress and the Bureau of Land Management that there is interest. The second step would be to start selling this property. Now, we talked in the green room about land prices, and land prices are a very important component to both the cost of building, but what gets built. And so just to reprise that, builders use a simple rule of thumb. I take 20%, I take the land cost, and I assume that that's going to be 20% of the total value that I'm going to end up with at sales price of the house. And therefore, I have to put $4 of improvements for every dollar of land, which means if I spend $50,000 for the land, I have to put $200,000 in improvements and sell the house with profit and everything for $250,000. If I have $100,000 worth of land, I have to put $400,000, which means I'm going to put a larger house. Even if it's the same size lot, I'm going to put a larger house on that because I have to improve the property to its natural point based on its value. I want to improve it to its highest and best use, its economic use. And if that's a single family house, I don't want to under improve an expensive lot, and I don't want to over improve an inexpensive lot. Because in both cases, I'm not going to be able to sell it very well. And so we basically said, okay, so now let's assume, it's been a while since I did this, that these lots are going to sell for, I forget, let's call it $60,000. And let's assume that 30,000 of that is the government's piece, what they would sell it for. And let's assume the other 30,000 is the improvements you have to make to the lot to make it what's known as a finished lot. And again, this land is clear, yada, yada, so we don't have any issue there, but you still have to finish the lot. So you have this 30,000, that becomes under the lottery where your ancestor got 40 acres and they brought the mule or whatever, or it actually was more like 640 acres. And they had to build a house within a certain period of time. Here it would be, you'd get this $40,000, which on a 300, let's see, what did I say? 60,000 times 5. 30,000. You get this $30,000 on this $300,000 house, which provides you a 10% down payment. But it also provides the builder with 2 things. It's in effect, a sold lot that he's going to build a house on. So he can go to a lender and say, I've already got buyers for this. This person won the lottery and has got an interest in this raw land to the extent of $30,000, because that's the second step. The first step is to register interest. The second step is you actually win the lottery. And now you have your certificate for this piece of land that the builder goes builds, and then you buy it and you have your 10% down and you qualify for the loan, yada, yada. And so that makes it easier for the builder and it makes it easier for the buyer, and you have homesteading 2.0 like your ancestors had in Kansas.
It makes complete sense.
Makes too much sense.
It makes a little too much sense for it to be put to work. Well, I thank you very much for the very thoughtful discussion, for the work that you're doing, for the realistic remedies that you have pointed us towards. We really have to unlock this quagmire, this Gordian knot that you've mentioned. It just seems to me really critical when you understand all this, then you can point your attention in the places where your advocacy can be the most effective. Well, thanks, Ed. That assessment of credit risk was right on the money. And your tailored prescriptions for what would help move the housing supply needle in unique places were thoughtful and, as always, data-driven. Now, audience, if you want more sensible and data-driven analysis, the resources Ed mentioned from AEI are linked in today's show notes. Check them out. The economists and housing policymakers follow Ed's work closely. You should too. And finally, I have a favor to ask. Whether you watch or listen, remember to like or subscribe. That helps the algorithm bring more of the content of special interest to you, and it helps others find us too. Thanks. And so for now, I'm Mary Schuster for October Research. We'll see you next time.